EastGroup Properties just delivered a massive Q2 2026, performing well ahead of management's own expectations, and they handily beat the street.
Oh, yeah. And the market immediately rewarded the stock with a really solid bid in after-hours trading.
Yeah, let's get straight into these headline numbers because they're big. So revenue, specifically, their income from real estate operations, hit $193.3 million.
Right.
Earnings per share came in at $1.40, up from $1.20 a year ago. Though, you do have to note that this includes a 10-cent per share gain from some real estate sales.
Yeah, which is why the real metric to watch here is funds from operations, or FFO.
Exactly, and that hit 2.36 per share. That is a 6.8% increase year over year.
It's a huge beat.
And looking ahead, management raised their guidance for the full year 2026. FFO per share guidance is bumped to a range of 9.52 to 9.66. Plus, development starts are aggressively projected at $325 million.
Which is just wild.
Right. Because if you look at these numbers in the context of the broader commercial real estate sector, which is currently busy, stockpiling cash and pausing projects, EastGroup is basically stepping on the gas while everyone else is tapping the brakes.
The contrast is impossible to ignore. Like, when you survey the broader real estate landscape right now, the dominant theme is capital preservation.
Yeah, nobody wants to spend.
Exactly. But EastGroup is deploying capital aggressively. Those headline metrics, especially that 2.36 FFO per share, tell a very specific story about the operational reality inside their warehouses.
For sure. And for anyone brushing up on the REIT metrics, FFO is the lifeblood number here, right?
Right, because it takes net income but adds back depreciation and amortization.
Because real estate generally appreciates over time, unlike, say, factory machinery that just degrades.
Spot on. So hitting 2.36 shows their core cash-generating engine is running exceptionally hot right now.
And that cash-generating engine is built entirely on their lease agreements. Like, we can trace that 2.36 directly back to the operational metrics. Looking at their same property net operating income, or NOI, we see a 6.2% increase on a straight-line basis.
Yeah, but
when you strip away the accounting mechanics and look at pure cash basis NOI, it jumped 8.3%.
And that is exactly what you want to see. That 2.1 percentage point gap between straight-line and cash basis is it's really critical to understand.
Break that down for us.
Well, straight-line accounting basically smooths out the entire value of a lease over its lifespan. So if a tenant gets, say, a month of free rent up front, or maybe they have predetermined rent hikes in year 3, straight line just averages all of that out into a flat monthly number on the income statement.
Okay, so it looks stable on paper.
Exactly. Cash basis NOI, however, ignores all those averages. It just measures the actual hard dollars deposited into EastGroup bank account this specific quarter.
So seeing cash NOI jump 8.3% means the actual liquidity flowing out of these properties is, it's significantly outpacing inflation.
Yes, and giving them immediate capital to deploy.
Which they are doing. And they have that kind of pricing power because their operating portfolio is effectively maxed out. They're sitting at 96.8% leased and 95.6% occupied.
It's basically full.
Right. And because they are essentially full, the leverage they have at the negotiating table right now is immense. Honestly, the most staggering number in this entire report is what happened when current tenants tried to renew.
Oh, the leasing spreads.
Yeah. Rental rates on new and renewal leases signed this quarter surged an average of 34.1% on a straight-line basis.
It's a massive number.
Okay, wait. Help me visualize this on the ground. Because I run, let's say, a local plumbing supply business out of a 30,000 square foot unit, and I've been paying $15,000 a month. My rent just jumped by $5,000 a month overnight.
Yeah, it hurts.
That is $60,000 a year, ripped straight out of my operating margin. How are these small businesses surviving that squeeze without just going bankrupt or walking away? Are they just squeezing tenants who are trapped?
Well, the reality is that for a lot of these businesses, the rent increase definitely hurts, but leaving hurts even more. You really have to look at what EastGroup actually owns.
Yeah.
They aren't providing luxury office space that can just be swapped out for, remote work or a cheaper suburb. They provide highly functional, mission-critical infrastructure.
Right.
If that plumbing supply business walks away in protest of a 34% rent hike, where do they actually go? In the specific markets where EastGroup operates, there isn't a cheaper, equally functional warehouse just sitting empty across the street.
So they're trapped.
Pretty much. The tenant is faced with a brutal choice. You either pay the 34% increase or you move your entire operation 30 miles outside the city center to find cheaper rent.
And if you move 30 miles out, I mean, your delivery trucks are burning more fuel, your drivers are sitting in traffic for hours,
Exactly.
and suddenly you can't offer same-day delivery to the construction sites downtown anymore.
And then your competitors who stayed in the city just take your market share.
Wow.
That is the exact trap, and EastGroup knows it. The supply simply isn't there to offer these tenants an easy escape route. So the tenant absorbs the rent increase because the alternative, losing their logistical edge in the local market, is basically an existential threat to their business.
Which means, to understand this pricing power, we really need to analyze the specific type of real estate they own. Because when retail investors hear industrial real estate, they tend to picture like a 1 million square foot Amazon mega warehouse out in the middle of a cornfield.
Right, the big box stuff.
Yeah, but EastGroup's portfolio is entirely different. They hold 65.8 million square feet of what the industry calls shallow bay industrial space.
It is a highly specialized niche for sure.
What does that actually look like?
So shallow bay properties are these multi-tenant, last-mile e-commerce and distribution locations. The individual units usually range from about 20,000 to 100,000 square feet.
Okay. So instead of leasing a massive structure to one global logistics giant, a single EastGroup building might be carved up into 4 or 5 units, housing a really diverse mix of tenants.
Like the plumbing supply company.
Exactly. You might have a regional auto parts supplier in one suite, a boutique local coffee roaster in another, and then, a mid-size HVAC distributor next door.
It's almost best to think of the industrial supply chain like the human cardiovascular system.
I like that analogy.
Yeah, so the million-square-foot big box warehouses are the main arteries. They pump massive volume across the country from the ports. But those arteries don't connect directly to the end consumer.
Right.
EastGroup's shallow bay properties are the capillaries. They're the smaller, highly localized pathways that actually deliver the final product into the specific neighborhoods.
That's exactly it.
And right now, the data shows the arteries are getting a bit clogged, while the capillaries are just desperate for flow. I mean, the report highlights that big box vacancy is currently sitting at 9.4%, while small bay vacancy is a much tighter 5.86%. And that spread tells the entire story of the industrial sector right now.
Yeah, the current gap between the two is 3.5 percentage points. That's substantially above the long-term historical average of 2.4 points because of the pandemic building boom.
Exactly. During the pandemic e-commerce boom, institutional developers just rushed to build massive big box spaces because they thought the endless demand from the mega cap tech and retail giants would never stop.
Right. They thought Amazon would just buy everything forever.
Exactly. And now that massive wave of supply has finally come online right when those mega cap companies are actively optimizing their footprints. So that oversupply is pushing big box vacancy up to that 9.4% mark.
But they weren't building shallow bay.
No, developers largely ignored the shallow bay market because it's just harder to build and manage. So that 5.86% vacancy rate remains incredibly constrained.
Okay, here's where it gets really interesting, though. I'm looking at a nuance in the data here. The report shows that big box is actually seeing consecutive quarters of vacancy decline, meaning that pandemic oversupply is finally starting to get absorbed.
Right.
Meanwhile, small bay is seeing minor incremental increases in vacancy over the last few quarters.
Right.
So if the big cargo ships are finding harbor and the small bays are getting slightly emptier, isn't EastGroup's structural advantage slowly starting to shrink?
It's a fair question. On a macro level, the gap is narrowing slightly, yes. But you have to synthesize what that incremental uptick in small bay vacancy actually represents here.
Okay.
It is not being driven by a flood of new shallow bay supply hitting the market. It is largely just natural tenant churn and maybe some slight macro softening. EastGroup's ultimate defense mechanism against that minor softening is that their properties are strictly what they categorize as location-sensitive infill sites.
Meaning they're geographically locked within already developed, densely populated urban footprints.
Right. An infill site is surrounded by existing city infrastructure. They are physically located near the major highway interchanges, right next to the end consumer.
So you can't just throw up a new building next door.
Exactly. It is virtually impossible to build new competing shallow bay assets in these areas. The raw land is either completely unavailable or it is prohibitively expensive to buy and redevelop.
Plus the zoning issues, right?
Oh, absolutely. Even if you find the capital, local zoning boards and neighborhood coalitions are incredibly hostile to new industrial zoning in urban centers right now.
Yeah, nobody wants more truck traffic in their backyards.
Exactly. This geographic reality places an invisible moat around EastGroup's existing properties. So even if overall national small bay vacancy ticks up a bit, the specific heavily defended infill locations that EastGroup owns, they maintain their pricing power.
You just cannot easily replicate their portfolio, and that
Yeah.
structural advantage is magnified heavily by where they have chosen to build that portfolio, right?
So
Because management is highly targeted. They are avoiding the Rust Belt and the Northeast entirely. Their Sun Belt concentration is massive. We're talking 35% of the portfolios in Texas, 25% in Florida, 14% in California, 8% in Arizona, and 6% in North Carolina.
the regional focus is the force multiplier for everything we've discussed so far. I mean, the earnings presentation highlighted a macro statistic that really underpins their entire strategy.
What was that?
EastGroup's specific markets experienced a 5-year GDP growth rate. Looking at 2020 through 2025, that was 37% greater than the U.S. average.
Wow, a 37% premium on GDP growth. And that just creates a cascading effect down to the specific tenants EastGroup houses, doesn't it?
Absolutely.
Because when millions of people migrate to Texas and Florida, they need new homes. That requires local home builders who need local roofing suppliers, who suddenly need 40,000 square feet of warehouse space near the new subdivisions.
Okay.
The population boom forces local businesses to scale up their logistics, creating fierce competition for a completely static amount of shallow bay square footage.
It creates a captive, organically expanding demand base. And management actually provided some revealing commentary on how this is playing out right now.
Yeah, CEO Marshall Loeb had some thoughts.
Right. Loeb stated that the leasing environment has, quote, normalized. Because last year we saw a lot of tenants hesitating, engaging in protracted decision-making because, well, everyone was terrified of an impending recession.
Sure.
Loeb is signaling that the hesitation has evaporated. Tenants are signing leases because the external macro trends driving Sunbelt growth are continuing unabated, and they just have to secure their operational footprints.
Right, and President Reed Dunbar added to that by detailing how this demand is dictating their capital allocation.
Yeah.
He noted that their record leasing demand is actively pulling their development starts upward. That is exactly why they are confidently projecting $325 million in new developments for 2026.
And to fund that $325 million without blowing up their balance sheet, they utilized the equity markets.
Right. They raised approximately $160 million in the second quarter through a continuous common equity offering, often referred to as an ATM or at-the-market offering,
Which is a great tool for them.
because it allows them to sell new shares incrementally into the open market at current market prices,
Right.
rather than doing one massive, highly discounted secondary offering that violently dilutes the existing shareholders.
It is a highly efficient way to access cost-effective capital, but it does raise a strategic question about timing.
Exactly my thought. So what does this all mean for the balance sheet? They're issuing $160 million in fresh equity to fund a massive $325 million development pipeline.
Right.
If you look at the broader economy, there are still plenty of warning signs. Aren't they worried about overextending capital? Like, if they are aggressively pouring concrete at the absolute top of the cycle and the macroeconomic environment suddenly cools off, don't they risk getting stuck holding a portfolio of expensive empty warehouses?
That is the classic pitfall for any real estate developer. I mean, the graveyard of commercial real estate is full of companies that built on speculation and got caught out when the cycle turned.
Right.
But Dunbar's specific phrasing during the commentary addresses this directly. He emphasized that their developments are strictly pulled by market demand.
So they aren't just hoping tenants show up.
Exactly. They are not speculatively building in the hopes that a tenant materializes. Their development starts are heavily pre-leased or driven by deep, verified tenant pipelines in those specific submarkets.
Right.
They are only deploying that $325 million because the demand is literally already sitting across the negotiating table.
Got it. So they're lagging the demand, not trying to front-run it.
Exactly.
Still, the possibility of a macroeconomic cooling brings us directly into the explicit risks outlined in their 10Q filing.
Always a fun section.
Oh, always. The forward-looking statement section is where management is legally obligated to outline exactly what keeps them up at night. And for a retail investor analyzing a REIT, These risk factors require just as much attention as the headline FFO beat.
Oh, for
The
sure.
filing explicitly highlights interest rate uncertainty.
Well, for a capital-intensive business like a REIT, the cost of debt is everything.
Mm.
But the 10Q risk isn't just about EastGroup's own borrowing costs. It's about their tenants.
Right.
If rates stay elevated or become highly unpredictable, the cost of capital spikes for that local plumbing supplier or boutique e-commerce hub we talked about.
Which circles right back to our earlier point. If a small business is facing tighter credit conditions and softening consumer demand, absorbing a 34% rent increase suddenly goes from being a painful necessity to a fatal blow.
Exactly.
Elevated rates directly increase the probability of tenant defaults and non-renewals across the entire shallow bay ecosystem.
And the filings also point heavily to ongoing supply chain disruptions and escalating construction and development costs.
Yeah, that's a big one.
Whether we are talking about new tariffs, geopolitical friction, or just the lingering effects of the inflationary environment, if the cost to pour concrete source structural steel and hire specialized labor continues to rise, the expected yield on that $325 million development pipeline will just compress.
Right, because EastGroup models a specific return on every dollar they invest in new builds. If construction costs blow past their estimates, those returns just vanish.
Exactly.
The 10Q also covers broader, catastrophic macro risks. They specifically flag the potential for acts of war, explicitly noting the escalation or expansion of the war in the Middle East.
Which is a huge global factor.
Yeah, any significant disruption there can shock global energy prices and completely upend the logistics supply chain that their tenants rely on. And additionally, they dedicate a fair amount of space to highlighting climate and extreme weather events.
Wow, right.
Given that 60% of their total portfolio is concentrated in Texas and Florida, the increasing frequency of hurricanes or severe weather patterns is a massive, highly localized risk for them.
It is the unavoidable trade-off of their entire geographic strategy.
Yeah.
I mean, you capture that massive 37% GDP growth premium by operating in the Sun Belt, but you simultaneously concentrate your assets in Hurricane Alley.
Right.
And even if their buildings are engineered to withstand the wind, severe weather can paralyze regional economies for weeks, causing major tenant distress. Furthermore, the skyrocketing cost of commercial property insurance in states like Florida eventually trickles down to the tenant level, putting even more pressure on their operating margins.
Let's bring this back to the balance sheet for a second, because the phrase interest rate uncertainty jumps out when looking at a REIT. I mean, it is the ultimate boogeyman for real estate investors.
Absolutely.
EastGroup currently carries over $1.6 billion in debt. When you look at their leverage, they boast a remarkably clean 3.0 debt-to-EBITDA ratio.
Right.
Just to clarify for the listener, an EBITDA stands for real estate. It's a metric that standardizes earnings by stripping out the noise of one-time property sales or impairments, giving you a true look at operational leverage.
It's standard.
Right, so a 3.0 ratio is solid. But does holding $1.6 billion in debt threaten that stability if the bond market remains volatile?
It's the exact right question to ask, but their financial mechanics are designed to actively neutralize that volatility. They do not leave their balance sheet exposed to the whims of the floating rate market.
Okay, how do they do that?
Well, the filings detail their extensive use of interest rate swaps, listing multiple active swap instruments in the $50 million to $100 million range.
Oh, wow.
Yeah. By utilizing these derivatives, they effectively trade their variable rate debt obligations for fixed rate predictability, heavily insulating their near-term cash flows from sudden rate spikes.
So they are paying a slight premium for the swaps to buy certainty.
Exactly, and it allows them to lock in their margins. But really, the absolute most comforting metric for a retail investor digging into this debt profile is their interest and fixed charge coverage ratio.
What's that sitting at?
That ratio currently sits at an incredibly robust 15.1.
Okay, meaning the cash generated by their operations is 15.1 times higher than the actual cost to service their fixed debt obligations.
Yes. And a coverage ratio of 15.1 is a massive operational moat. It means that even if a severe macro shock materialized, say, tenant default spiked or leasing velocity plummeted, EastGroup has an enormous buffer of existing cash flow.
So they aren't going to go under.
Exactly. They can comfortably service that $1.6 billion in debt without forcing fire sale asset liquidations or, cutting the dividend. The leverage exists to fuel growth, but the underlying cash generation more than justifies the debt load.
It really paints a cohesive picture of a management team that has identified a highly lucrative lane and just built a fortress around it. I mean, they are perfectly positioned to ride this massive wave of Sunbelt migration while operating in a shallow bay asset class where supply is strictly constrained by urban zoning and high land costs.
Yeah.
It explains exactly how they have the leverage to push rental rates up by an average of 34%.
They are executing a highly defensive, location-sensitive strategy that organically creates intense pricing power.
But the ultimate question moving forward isn't really about EastGroup's execution. It's about the breaking point of their customers.
Right.
Because as inflation and construction costs loom over their tenants and interest rates remain a wild card, you just have to wonder, how long can EastGroup maintain these spectacular leasing spreads before they hit a hard ceiling?
That's the million-dollar question.
At what point do the 20,000 to 100,000 square foot businesses that occupy these spaces simply run out of margin to absorb a 34% rent increase? That number is a testament to EastGroup's current dominance, but it is simultaneously a stress test for the local businesses holding up the entire Sunbelt economy.
Yeah, it's definitely something to watch closely over the next few quarters.
Absolutely. If you want to stay ahead of the curve on numbers like these, make sure to follow the show for our daily earnings coverage.